Bloomberg Audio Studios. Podcasts, radio, news. This is the Bloomberg Surveillance Podcast. Catch us live weekdays at 7 a.m. Eastern on Apple CarPlay or Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
The hallmark of Bloomberg surveillance is we rip up the script when we have to. We do that now. I was going to go to Sebastien Page on something else. Torsten Slack of Apollo publishing moments ago, Sebastien Page at Rowe Price with us. U.S. workers contributed $8,500 to their 401k accounts, 71% of the assets allocated to equities. The Magnificent Seven have a 40% weight, S&P 500. The bottom line is that each worker in the U.S. puts an estimated $2,300 into Mag 7 stocks every year. The dangers of passive investing. How do we have the perfect guest for this? Sebastien, discuss.
Well, we're at an all-time high or close to in terms of the concentration of the markets, and that is a risk. I think Torsten makes a point here where you keep getting inflows into market capitalization weights, and in a sense, it's self-reinforcing. Yeah. My view is it is in part contributing to this all-time high market concentration, except those companies are pretty great.
On a physics basis, like in your fabulous book on diversification, on a physics basis, it's an inertial force. How much of a drawdown do we need to see where we break that inertial constructive force? 5%, 10%, bear market?
Well, it's interesting the way you phrased the question. How much of a drawdown do we need to get the market broadening? That's an assumption we're making, and I think it's the right one, that in a drawdown, we will see broadening. If you look at how value stocks have been behaving over the last 2-3 years, every time we get a 3-4% move daily on the downside, value stocks outperform. So my view is that a big drawdown in the markets would be almost mathematically, has to be driven by maybe an AI scare, something going on to unwind market concentration. By the way, right now in our asset allocation portfolios, we're long diversification.
What's that mean?
So we have an overweight to non-U.S. stocks. We like U.S. stocks for the long run. But right now, if you look at the fundamentals outside the U.S., the valuation and some macro catalysts, increased spending in Europe, still dovish central banks, it all lines up for a continued outperformance over, say, the next 6 to 12 months of non-U.S. stocks. We also like the value and SMID sectors outside the U.S. That's how we're playing most of our diversification. In credit, we also like a broad set of credit exposures on the fixed income side.
And just going on the fixed income space on the credit side, the best performing sector has been U.S. high yield. So it doesn't seem like the market's too concerned about, at least in the fixed income market, the high yield market, about the recession scenarios out there.
Yeah, it's fascinating how tight spreads are. Yeah. And as valuation sensitive investors, we still have a long credit exposure because, and our head of high yield keeps reminding our asset allocation committee every time, this is not the same asset class that it used to be. So if you draw a chart of high yield spreads over time and you look at where spreads were in prior market cycles, you're looking at a different index. You're looking at an index that is lower quality, more energy sensitive. We do at T. Rowe Price a bottom-up analysis of issuer level default probabilities. So we build it up for the entire index. And those numbers, based on our assumptions, are lower than the norm, slightly lower than the norm, and definitely not recession level.
I know, I'm just looking at your notes that you've been traveling a lot, meeting with your T. Rowe
Too much.
Price clients. I'm guessing...
He's trying to find middle relief for the Baltimore Orioles.
Exactly. I'm guessing one of the questions you get is, are we in a bubble in the U.S. equity markets? How do you respond to that?
I saw Aswat Damodaran, who's, I think, a reference in terms of valuation in the media, say, I'm not using the B word. And his argument is the earnings are there. The earnings growth is there. As we go into the third quarter, I get my Jonathan Golub earnings email this morning.
I hate him. I have to read it.
But he's looking at, he goes 9% year-over-year growth still. And with 12%, he's expecting with the surprises. So the earnings are there. So Damodaran's out there saying, we're not in a bubble. I'm not using that word yet.
Have you seen it? We got to run here, but Sebastien, we got to get you back for a long segment highlighting the intelligence of your book. But let me cut to the chase. The uproar of the anti-worry crew of AI, was there an equivalent in 2000? I don't recall it.
See, that is such an interesting point about sentiment. When I was thinking about this on my way here this morning, when everybody thinks we might be in a bubble, counterintuitively, that's kind of a good thing. It means there's some conservatism. Late 90s, it was really, you have to travel back in time and put yourself there. Just remove the hindsight bias that this went berserk and it blew up. In the late 90s, people believed it. People believed it. And so now it's so different in a way, similar in certain ways, but different in the sense that those are cash flow generating businesses, not finance with that.
Come back soon. Sebastien Page with us, Rowe Price here. Stay with us. More from Bloomberg Surveillance coming up after this.
You're listening to the Bloomberg Surveillance Podcast. Catch us live weekday afternoons from 7 to 10 a.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
Joining us, Jay Timmons, President and Chief Executive Officer of the National Association of Manufacturers. And this is great, folks. He's got this bio that's like 6 pages long. And Lisa, this is what Sweeney would expect. Paragraph, paragraph, paragraph. And then there's a single line, and then there's more paragraphs. The single line is, I went to the Ohio State University. And Jake, last time you were in was weird. We got a huge response. And the bottom line is you are hardwired. You're in Virginia now, the corporate thing, and that with the National Association of Manufacturers. But you understand the tradition of Detroit down the interstates and manufacturing America. What's the number one myth that the public gets wrong about manufacturing in America?
Well, that it's taken for granted, right? That we're always going to be making things, and that's not necessarily the case. You got to have the right policies in place, and we've had a run of really good policies this year that has helped manufacturers have more confidence in investing and hiring in America. But those things aren't given. It should never be taken for granted.
So talk to us about the manufacturing economy in the U.S. right now. It's in contraction. It's been for a while. Talk to us about what you're seeing out there.
Yeah, it's funny because you do see that data. There's no question about that, Paul. But I hear from my members. We just had a board meeting last week. I've got a very small, discreet board of directors, 250 members of America's industrial.
That's a lot of sink.
It's like a little Congress, but you get a lot of great
we call
feedback.
it the French government, actually. But continue.
Well, I'm hoping we have more stability than that one. So what I'm hearing from them is a lot of optimism, right? That we have the conditions that are ripe for investment and job creation, but there is still some pause in that, and especially when it comes to tariffs and workforce policies.
So how are the manufacturers out there dealing with the uncertainty with tariffs, maybe the workforce issues with migrant labor no longer being a supply of labor? How are they dealing with that? Yeah,
so it's an interesting conundrum for manufacturers because manufacturers, by and large, certainly from what I've seen, and of course there are always exceptions, but I've always seen manufacturers following the rules. They're by the book. They're hiring legal, labor that has all the right papers. But when other sectors of the economy see a hollowing out of some of their workers, we're suddenly competing for labor. And today we've got 400,000 open jobs in the sector. Wow. And we've talked about it in the past, Tom, and we're always trying to attract that next generation. That number is going to grow to 2 million by the year 2033.
Okay, this is the heart of the matter. I interviewed Senator Grassley years ago. I think he was young then. He was like 82 at the time. He's a former welder out of Iowa in World War II, and the cliche is we don't have enough welders. The politicians are signing deals saying we're going to take high manufacturing Asia and bring it over here. Jay Timmons, do we have the warm bodies to build an Asia-like manufacturing force?
Today, no, but that doesn't mean we can't get there. And we have to prioritize the right things. You and I have talked about trade schools in the past and the importance of trade schools and community colleges and really orienting our...
How are they doing now? I mean, there was BOCES in New York State, BOC,
I think,
ES.
It's growing, right? It's getting there. That is the challenge we have. It's important to make sure that young people know what cool opportunities, you use the word cool, I say sexy, opportunities are available in manufacturing today. More importantly, it's getting their parents to understand that as well, because oftentimes parents will say, hey, we want you to go in this direction or that direction. They don't realize what great opportunities exist in manufacturing.
Yeah, I mean, Paul, this is the heart of the matter. The parents want them to take Lockean philosophy at Duke. And the kids, what's the average salary of one of those kids? You took 5 years out?
Yeah, so it's like, it's around $100,000.
So they're talking six-figure incomes moving a wrench.
Yep, no college
That's a stereotype,
debt, presumably. So, Jay, what are the key challenges for you and for manufacturers today?
So let's start with the opportunities, right? So we had great we had great news this year when we got the tax reforms made permanent.
Right. Yep.
That really helped supercharge, I think, optimism. Regulatory modernization has been good for manufacturing. The president's focus on the administration's focus on energy dominance has been very positive. But the greatest challenges are, as we just talked about, workforce, but also the uncertainty of the current tariff policies that are happening in this country and the added costs that come with that. I would tell you this: the one thing that we're really watching closely. The president clearly wants to grow manufacturing capacity in this country. Well, so do we, right? That's my job. In order to do that, we've had our economists crunch some numbers. If we had every machine running in this country today, we would only be able to make 84% of the critical inputs necessary to build that new factory.
So what would you say to Donald Trump? I mean, what would you say to the president about this? I don't want a photo shoot on the White House lawn of some big tractor trailer like we're Manly and we're going to get the vote in Ohio. You're the reality. What do you say to the president or the next president?
Yeah, help us help you do this, right? So, and the way to do
LBJ tax credits?
The way to do it is to look at those critical inputs that you need. So think in terms of machines, right? And the administration just announced a 232 investigation on machinery that would add tariffs. Well, if you're tariffing that product, and the purpose of that product is help build new manufacturing capacity, that doesn't seem to add up. So if we have some sort of a speed pass that allows us to bring that equipment in duty-free to build manufacturing capacity, we think that it's a win-win for both.
Common sense.
You don't see that in the zeitgeist.
No, it's just common sense.
Well, we've been talking. Listen, we've been talking to the administration. We're getting some good response about exactly that. Targeted focus on making sure that we can bring in the right things to build manufacturing.
Please come back again. I mean, we start strong in this hour. Sebastien Page and Jay Timmons, and we should have had both of them for like an hour each.
I'll always come back if you always say the Ohio State University.
The Ohio State. They look pretty good this year. I mean, there's all these upsets in this. Well, and Ohio State is just like normal Ohio State.
We got to wait to see what happens with the big game right after
When
Thanksgiving.
you were an undergraduate, this is like what Michael Barr used to do in Detroit. Did you drink in every bar in that corridor of bars?
So there was a bar called Larry's there that I did once in a while frequent.
Yeah. What was the beverage of your choice?
Sadly, well, I was young enough, or I'm old enough that legal age was 18, so I drank tequila.
There you go.
But I have to tell you,
Salsa Green Label.
But I have to tell you,
what are you laughing
whatever
about
the cheapest is. I have to tell you, I was a geek, so I went around the state starting young Republican clubs. So
very good.
Didn't really have all the fun.
Jay, Lisa and I, surveillance correction, folks. Mateo and I, it's also white label. It's more chewy than the green. The rich kids had the green label, and we had the white label.
We also had grain alcohol, which was a really bad.
That's Ohio.
A southern thing. That's like Paul's familiar with that. Jay Timmons, thank you so much. Stay with us. More from Bloomberg Surveillance coming up after this.
This is the Bloomberg Surveillance Podcast. Listen live each weekday starting at 7 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
We're going to get right to it. For the last week or so, and with great guidance to Dennis Gartman and his amazing call on gold and yen, really a call of a decade. When are you going to have the gold guy on? When are you going to have the guy with the affable British voice on? Right. When are you going to have James Steele on? In the studio now, worldwide, James Steele, Chief of Commodities for HSBC. Wonderful to have you here. How is this gold move, this silver move, different from my Ute, where I'd go to cocktail parties with my parents and see Jenny Cream ales, and everybody was gold and silver crazy? How's it different from 1980?
Well, thank you, Tom. Thank you for having me. I think one of the differences that we've hit real highs. You know, the market was talking about a series of highs for the last year and a half, but really it wasn't until April that we hit real highs in real terms. In January of 1980, gold hit $850 an ounce, and that is a little bit shy of $3,400 in today's money. So we didn't pop that figure until April. And I think what makes it different now is that we have a different monetary regime. Volcker it was just coming into power, and that's why the market dropped after that. Also, the geopolitical risk climate is different. We have more entrants, and we have a very types of entrance into the market. Right. And we just have a lot of elevated risk. And what is interesting is that this is occurring aside very powerful equities. So a lot of the buying in gold is safe haven.
Paul's got 8 questions. We'll center around what to buy next at the jewelry store. Let me just ask a dumb question. In everything else in the world, if price goes up, we make more of it. That's the way Adam Smith told us things work. Alfred Marshall told us that. If the price is up, are we mining more gold?
Well, we can't. We are mining a bit more. But mining is a very long process, and it depends on a very long investment cycle. Say, by the time a couple of geologists say, I think there's some gold here, it can be 10 years before it goes around your finger. It used to be 5. Sometimes it's much, much longer than that. And so there are constrictions to how quickly you can raise production. You can change grading and things like that. But really, it's set on these long-term cycles. What is flexible is recycling. And I think all the time I've been covering gold, the recycling market has steadily risen as a greater percentage of the share of supply. And I would bet that at this price, we've got some potentially significant recycling that could come online.
How does that work? Where do we see recycling? How does that happen? Do I just go to the guy on the corner and give him my ring for cash?
It goes from that level. It goes from gathering up all the jewelry in your house because we're at record highs, or it goes right up to old bars that may be cracked, that may not be London, what we call London good delivery. Okay. Which is the only type of bar that HSBC and other bullion banks will be. London good delivery.
So that means it's a high quality bar?
That means it's been assayed and produced by a verified LBMA, London Bullion Market Association. Nice. Entity, and they've said this refinery is correct, and therefore you know what you're getting. So it goes from there right up. But there is a lot of gold in the world, and it can be mobilized at high prices.
Bloomberg Surveillance, James Steele of HSBC with us, definitive on gold, red and green on the screen right now. The metal, Sweeney following this tick by tick, 4,073 up $3. Paul?
Just amazing. Who's buying gold at these levels, do you think? Is it just the ETFs? Is it central banks? Is it all the above?
Well, I think what we have seen is less retail demand. Okay. Small bars and coins have suffered greatly under these higher prices. Say, for example, if you had bought a coin at $1,500 an ounce, which you could have just a few years ago, you probably won't buy another one or at this price, or you may even hand that in So if you look at what's being produced by the mints, it's quite low, and a lot of coins are coming onto the secondary market, and also small bars. I mean, the 10-gram bar is the favorite bar in India, a very small bar, well over 100,000 rupees. It was 35,000 rupees just a few years ago. But to say who's buying, it's heavily institutional.
Okay.
Asset managers, all range of people who are seeking diversification.
Giovanna Bracecci was on today on Gaza and Israel and President Trump, and from Dubai. And I once visited quickly the Dubai Gold Souk, which is how you consume in the Middle East. It's totally different, folks, than the jewelry district in Manhattan, Tiffany's, et cetera, et cetera. In Asia, in South Asia, at the Dubai Gold Souk, how has gold at 4,000 changed the cadence?
Well, about 50% of all gold that's bought in the world is in jewelry form and physical gold, and 70% of that is in the non-OECD world, and that demand is down double digit, and it was down double digit last year. So we have this severe reaction in the jewelry market, as one would expect.
I'm doing the math in my head. You just said 70% and 60%, which is 40% of the gold consumption is non-OECD jewelry.
That is correct. And half of all the jewelry bought, half of all the physical gold bought in the world is divided between India and China.
And what did they buy it as a store of value? Did they buy it as a hedge? Did they buy it as they just like it?
Well, there's a traditional historic relationship with gold. I mean, traditionally, gold has been more popular in places, and I'm not saying India or China have weak institutions, so please don't think that. But historically, gold has been more popular in places that have had higher inflation, less stable governments, things like that.
How does James Steele link the debate? I mean, Ken Griffith was on with Francine Lacroix. The debasement debate, dollar's going to weaken, we're all going to die by gold. In the geopolitics that you mentioned at the top, is that overemphasized in your analysis, or is it germane?
It might be. Well, it is germane, but it might be somewhat exaggerated at the moment. Now, in all the years, in the years that I've been covering gold, the same 12 or 15 factors covered it from the day I started looking at it until now. The trick to analyzing it, or the trick to having some idea about where the prices might go, is the ranking. And geopolitics has risen.
Okay, let me cut to the chase. Is Ken Griffin right about his ranking and worries, hand-wringing worries about the global financial system?
Well, I wouldn't comment. I don't think I'm allowed to comment on Ken specifically. But if you look at the geopolitical risk index and the economic policy uncertainty index, they're both very, very high. And gold has a nice running regression analysis or link to that. We've gone back years and seen this relationship.
That's so James Steele. I mean, that's why he's here. James Steele, HSBC. We continue with this important conversation. We welcome all of you across the nation, around the world. Good morning on YouTube. Subscribe to Bloomberg Podcast. Paul Sweeney.
Do commodities investors, particularly in gold, do they think about, or how do they think about valuation? Is it just, do they think about valuation? If so, how do they think about valuation?
I don't think you can look at gold and valuation in the same way as you can other things. For example, it's well above the cost of production.
Okay.
Double in most cases. Yep. So I don't think that really works. You also have to take into account reserves and things like that. So it is a more complicated.
So people don't come to you typically and say, "Boy, I think gold's expensive," but they will say, "Has it run too far, maybe?" Or is it?
Yes, that's right. That's right. You wouldn't get many places by comparing the cost of production and supply alone to how the price would go.
If you're on a weekend, you're out being the social James Steele, and somebody says, "I need to buy gold," what's the James Steele way to acquire gold? Lisa, step in here. Is it aisle 6 or 7 where you can buy gold bars at Costco? I mean, help me here. What's the most intelligent way to buy gold?
Well, I think it depends on I always think the ETFs are a good play, because you can buy any amount, you don't have the problems of storage or insurance. And so I think that's the best. Yeah. I think that's amongst the best way.
Are there still Krugerrands?
They are in the market. I don't think they're being produced, but the big coin producers are the U.S. Mint and the Royal Canadian Mint, and the Royal Mint in the U.S. and the U.K. and Austria and Australia. Also.
So right now, the United States of America is making gold coins?
Well, yes, but I've just been looking at the data, and it just doesn't apply to the U.S. Mint. But the amount of coins sold in August was a tiny fraction of what was sold in August 2024. The high prices
just because of the price.
Yes.
Paul, do you have a gold coin? I do not have a gold coin.
No, I don't think I do. And my question is, historically speaking, what's caused gold to go down and go down?
Great question.
Well, that's what we're examining now. Now, something that might surprise some people is an equity correction could trigger a gold correction. And the reason for that, you would think if equities go down, the gold market would go up. But what happens is that those who bought gold as a hedge against an equity correction, which is a significant level, a number, they liquidate either end of that day or the next day and the following day. So an equity correction could very well trigger a knee-jerk reaction in the gold market. The other thing, too, is these geopolitical risk levels are high. And I mean, I don't predict the future, of course, but a settlement in Ukraine, and I'm not saying there will be one or there won't be one, but some rapprochement between the West and Russia, possibly better U.S.-Sino relations. There's a number of things that could feed into a de-escalation in risk.
I love this, Paul. I'm learning so much. How about this? Walmart. Have you ever been to Walmart, Lisa?
Of course.
Okay, thank you. Gold coin. Canadian gold maple leaf 1 ounce gold coin, random year, $4,278.24.
There you go.
Every time the Maple Leafs lose, you buy one.
Exactly.
Something like that.
All right, so gold up 55% year to date. I can do you one better. Silver up 76%, $51 an ounce. What's going on with silver? How do you think that? Is that just I don't know how to.
Well, this is where, one of our research pieces was silver's golden chariot.
Okay.
That, that the silver has been buoyed by the gold.
Okay.
And when gold rises, some people don't participate fully in the move. They would like to be in precious metals, and they'll go into silver or they'll go into platinum. Typically, they will not do it in palladium. Now, the other so that's been a big plus. The other thing, though, is more technical. There is less gold in London, in the London warehouses right now. Okay, London is the center for cash spot physical trading. New York is the center for futures and options at the CME, the old COMEX.
Right.
Now, when we had the tariff concern, and I was on this program and spoke about that, we saw an enormous amount of bullion come across the ocean towards New York in case the tariffs were put on. Well, a lot of that silver is still here. And it's so I wouldn't say there's a shortage, but there's less of it in London. It keeps pushing up the spot price, and until the stocks get leveled out again, which may take some time, this silver has been buoyed by that.
Does silver have the biblical emotional value of gold? I mean, this sounds like 1880, William Jennings Bryan, the silver coin debate. But like, if somebody perchance had a silver Tiffany bangle, like Paloma, Lisa, help me here. Who was it? Paloma Picasso. It's one of those modern things that you see. It's silver.
Okay.
People collect them from time to time. Does that silver have relative value to gold? Or does a guy like you look at it and go, you fool?
Oh, no, it does. There's just a lot more silver in the world than there is gold. Interesting historical thing that your listeners may enjoy. For thousands of years, the ratio for gold to silver was 10-1. You go back to the Bible, Persia, China, India, etc., etc. When the Spanish and the Portuguese went to the Americas, it wasn't so much gold they brought back as silver. And they brought back so much silver from the new world to the old world that it irrevocably altered the gold-silver ratio.
So like an Elsa Peretti small bone cuff in sterling, $1,800 at Tiffany. Do you, James Steele, look at that like the same as you look at gold?
Well, you would, but that high end of the jewelry market is not important to us because not much of it is sold and there's no relationship to the price. That's why jewelry demand moves in the East, because the markup is lower and the hedging practices are different.
Which geography do you most look at? We got to go. Which geography do you look at most in the East?
China, India.
Oh, I thought you were going to say the Hamptons. China and India. Can you give me a city?
Cape Cod. Look at the Mumbai premium or discount and the Shanghai premium or discount.
There you go. News you can use.
Absolutely.
Was this great?
Perfect.
We could have you on for like 3 hours.
Wherever they keep their stuff.
Can we do a remote from the HSBC vault?
We're going there.
That would be cool. Probably there's no Wi-Fi.
Right, exactly.
Small detail. James Steele, you are a trooper with the Hong Kong, Shanghai, and Banking Corporation, HSBC. Stay with us. More from Bloomberg Surveillance coming up after this.
This is the Bloomberg Surveillance Podcast. Listen live each weekday starting at 7 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.
For Global Wall Street, this is a treat. He's got one of the great double majors of America, systems engineering, economics, Wharton. Joining us, Nelson Yu. He holds court at AllianceBernstein. A single sentence of absolute brilliance in your note. We have shifted from a self-financing AI CapEx over to getting financing outside other sources. Discuss.
So I've been really worried about some of the enthusiasm that's going on across this AI investment that's going on. If you look at, especially in the small caps, some of this energy infrastructure that's being built out, they're putting in CapEx that's not going to come online for another 10 years. And we're seeing more and more debt financing starting to creep up.
Boston University, Zvi Bodhi, he owns this territory. You do financing outside the companies and everything gets tranche-like complex. Paul, I still to this day don't understand mezzanine and mezzanine financing. Do you see parallels here to the idiocy of previous upsets?
I think it's early. So we're just starting to see this start to happen and come in where more debt is being used, but there's still a lot of cash and revenues that's available. The big companies still have lots of revenue that they can apply to this CapEx. But what we are seeing across the mega caps is while earnings continues to go up, we're seeing free cash flow starting to plateau because of the amount of CapEx that needs to go into these investments.
But the bulls will tell you, they've got literally 90 billion, 100 billion of free cash flow. Maybe that's down from 120, 130. But the returns are going to be so great. So it's a little bit of a show me story. Well, maybe it's more than a little bit of a show me story. It's a pretty big show me story for a lot of these expenditures. But the market seems to be willing to make that bet.
For now, we're okay.
Okay.
So as long as we continue to be able to fund this through revenues, we're starting to see yellow flags, but it's something to watch.
I was looking through your notes. I know you spent the last couple of weeks visiting your clients in Asia. What's some of your takeaways?
I think it's really interesting and actually goes to what we just talked about. There's a fatigue across this AI story with U.S. growth equities. And when I'm in Asia, the number one thing they wanted to talk to me about was international investing. Not global investing, which is what they normally want to talk about, but really how do we separate U.S. from international equities?
What's the distinction between international and global investing?
International just doesn't include the U.S. Okay. So when they talk global, we just want it all in one portfolio. When they want international, they control the U.S. allocation and the non-U.S. allocation separately. What they've come to realize is with the run-up of U.S. equities, and especially U.S. growth equities, their portfolios are massively overweight growth and technology.
Right.
So if you go outside of the US, you start to get exposure to many different types of themes. You've got industrials, financials, consumer. That's available, and the correlations are falling.
We played Brian Adams' Run to You in the last hour. I feel like I'm having a conversation when that record came out. Okay, let's go right there. Robert Mundell, we mentioned it with Richard Clare, the vice chairman, yesterday. I'm sorry, currency is litmus paper. Well, nobody's talked about this in the zeitgeist of the last 20 years. All of a sudden, dollar dynamics, yen, yuan dynamics really matter, don't they?
They do. And look, I did currencies about 10 years ago. And back then, we always talked about these long cycles of dollar strengthening, then dollar weaknesses. Back then, it was about 7 years in that cycle. I think the worry is, are we just at the beginning of a dollar weakening cycle? And given all the dynamics on the macro front, you could see that there's reason to think about the dollar could weaken from here. Now, that being said, with dollar weakening, that's really supportive for things like emerging markets, which depends on dollar financing.
So dollar bulls would come back and say, hey, we're still the most profitable, most country out there, the most efficient, and so on and so forth, which has been, I guess, one of the underpinnings of the dollar bull case for a long time. Have those things changed, or maybe even on a relative basis?
If you're talking about companies, I would agree with you that the U.S. companies remains an anchor for your portfolio. It's such an important part of having those companies that have those strong profitability, deep moats that protect that self-generating profitability.
It sounds to me, Nelson, we're going to go here in a moment. Lisa Hornby on hold with Schroders. But, and Nelson, what I'm hearing here is a partition of MAG. Like MAG 7 versus what? MAG 100? There seems to be a partition between the juggernaut cash flow generation of Microsoft and 6 companies I don't know.
I think there's a much broader set of opportunities outside of the MAG 7. And what people are forgetting is the opportunity that exists outside of AI. You've got in the US reshoring of manufacturing, logistics, and even the supply chain that needs a lot of investments. And you've got very profitable companies that generate strong returns. And then you look outside of Europe and you've got many macro-aligned themes in Europe, in Japan, and even in China that you can invest in.
Earlier this year, when we had the tumult, I guess, when the launch of the tariffs, a lot of money moved out of the U.S. A lot of it went to European equities. What are you seeing there? Was that a short-term trade? Does that money come back, or is that kind of sticky over there, do you think?
No, I think there is some stickiness here. And what you've got in Europe is you've got financial stimulus, you've got fiscal stimulus, you've got monetary stimulus going on, you've got $1 trillion of investment going on for Europe. And that's triggering profits worldwide. Actually, what we're seeing in Asia is defense companies in Asia are profiting massively from Europe's need for defense spending.
We got to leave it there. Come again. Just really appreciate it. It's a crazy day. Nelson Yu with us, head of Equities, AllianceBernstein. Thrilled that you could join us.
This is the Bloomberg Surveillance Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 7 to 10 a.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.